If you were to ask the university academics about the market and about how money managers do, if you ask people who write books and do the studies, not the people who are trying to sell you a book or trying to sell you a system or trying to get you involved in what they're managing money, but the people that are actually doing the studies, the people that are actually looking at the market, they'll tell you that to beat the Standard & Poor's 500, it's a foolhardy exercise, that it's almost crazy that you should lower your expectations. Look at the books that were out. One of the famous books, Random Walk Down Wall Street, or How to Win the Loser's Game, or The Incredible Shrinking Alpha. Every year or two, books come out saying it's impossible to beat the Standard & Poor's 500. But then how do you explain that over the past 17 years at Adams Financial Concepts, our clients have done exactly that? They've beaten the Standard & Poor's. We take the composite of our clients' accounts, taking the after fees, after cost, the actual amount our clients see, those are compiled together, and we do a composite, and we compare that composite to the Standard & Poor's 500. Do you know what? It beats the Standard & Poor's 500. Not every year. Over the last 17 years, it's underperformed 6 years and overperformed 11 years, and the total is an outperformance. So is it just by luck? Is it coincidence? Is it really? And we don't carve out any clients. We don't take any special group of clients. It's all of our growth account clients. Over 120 of those accounts. So how does that happen? Is it by coincidence? I don't think so. Nor do the people and our advisors at AFC. We have a very determined philosophy and strategy, and today we're going to share that. We have Al Souza and Christiane here. They're going to share those three principles on how we've been doing it, not just for 17 years, but before that, I was 18 years with other firms, how we've done that. So I want to start. There's three principles. Let's start with the first principle, and let's start with Al Souza. Al, take it away.
Hi, Mike. So the first principle is getting twice the upside as you do the downside, right? Because if we have twice the upside of the downside, you don't have to be right 66% of the time as they suggest.
Yeah.
Right? You can, in fact, make money being right half the time or less. It's about picking the right stock selection, doing the deep dive work. So let's say you buy 3 stocks and you pay $10 a share for each 3. Okay, three stocks, 3 different companies, you pay $10 a share. You pick the right stocks, we determine that they have a potential of going to $20, 2 times the upside, or $5, right? The downside. If we find the right, if we find stocks that have twice the upside as the downside, we only have to be right, let's say, to make money, excluding commissions, only a third of the time.
Right. So 2 can fail and
yes,
one make it.
2 can fail and 1 can make it. And it's the simple principle that you can be right just a third of the time and still make money.
So that's the first principle.
That's the first principle.
So remember that. Twice the upside is...
Twice the upside is the downside.
So the second principle, let's talk about that. Chris?
Yeah, and so to piggyback off of that, if we have twice the upside as the downside, we like to play out a little game to show kind of how we invest. So imagine you were going to play a betting game and you had $100 to start with and you had to make 100 bets. So if you bet $1 and you win, you get $2. If you lose your $1, right? So if you were to play this game out and you had a 50-50 chance of winning, there's a number of ways you can play it. The first is if you had a $1 each time, 100 times. The first time you bet and you win, you have $102. And then let's say you play it again and you lose. So now you're back to $101, right? So twice the upside compared to downside. So at the end of 100 turns, if you play this out and you win 50 times, you'd have about $150, 50% return. It's not bad. You got an increase on your money, 50%. And so we like to play this out because it shows with a 2-to-1 upside, we really only need to be right 50% of the time according to the math.
But there's another way to play the game.
Yeah, it's playing, instead of just betting 100 times, right? We're going to play a percentage, right? Let's say we bet 10%, right? So instead of betting $1 each time, we're going to bet 10%.
10% of $100.
So if you bet 10% of $100 and you lose, the first lot lets you down to $90, right? So then you bet another 10% and you win, you're back at $108, nine. So you can see that twice the upside as opposed to one time the downside. If we play that out,
we get to $4,700.
If you continue to play that out, instead of ending up with $150, you'd end up with 100 plays, you'd end up with $4,700. That's not bad. And it doesn't matter if you lose the first time. If you bet $10 the first time and you lose, you have 90. You bet $9 the next time and you win, you're back at 108. The sequence doesn't matter because the math is commutative.
Right.
So it doesn't matter what order we put it in.
And if you bet $10 the first time and win, you get 120. You bet $12, you lose, you have 108. Just exactly what Al said.
Yep.
Doesn't depend upon the sequence of wins and losses. It's, if you do it 50 times, the expected value is 4,700. What if you bet 25%?
If you bet 25% and you do 100 plays, you end up with $36,100.
And what happens if you bet 50%?
It just keeps getting better, right? No. Because if you bet 100% and you lose, what happens? You're out of the game, right? If you bet 40%, it works out the same as if you bet 10%. I know this is getting a little confusing, but if you bet 50 or 51%, you end up with $36. That's the way the math works. So anything over 50% tells you you're betting too much.
And if you bet 100%?
You're out of the game if you lose. If you win,
That's right.
Great, but that's a lot of risk. We don't want to take that much risk.
So I came up with this idea because I'm a mathematician. And this is game theory, looking at it in terms of what the bet is, betting a percentage. If you look at the best percentage to bet, it's 25%. 25% means 4 stocks in a portfolio. That works out to the best increase if you really want to have the best increase. The problem is that's only looking at the upside. What happens to the downside? So for that, Chris?
You know, Mike, if we only put 4 stocks in a portfolio, we would be taking quite a bit of risk. And,
Correct.
you know, our clients don't pay us to take a bunch of risk. They pay us, you know, for the returns. And so what we find out is that it's actually better to have, you know, around 10 positions in a portfolio. And this may seem a little risky. This may seem out there, right? But it's really not. If you were to look at a lot of the different mutual funds that most people are in, Morningstar actually did a study that the top 50 to 80% of the picks, your top 10 holdings, right, are going to be 50 to 80% of the total mutual fund. Well, then what's the rest of the holdings? What do they do there, right? Well, it's really just that added look of diversification. And it's funny for me because I came out of school, I graduated a few years ago, and I took a number of finance courses. And what they preach is diversification. They teach, you need to have, 300 to 500 stocks in a portfolio. Granted, they don't go that deep, but what they tell you is that you need to own essentially everything. But what we're finding that most of the great investors do, like Warren Buffett, Evans Archer, William Sharp, they're finding that only a couple positions in a portfolio, concentrated positions, are actually going to outperform over the longer term. I think Warren Buffett said it best, and I like this one here. He says, "Don't put all your eggs in one basket." Is all wrong, right? I tell you, put all your eggs. I'm sorry. Andrew Carnegie said this. He said, "Don't put all your eggs in one basket." Is all wrong. I tell you, put all your eggs in one basket and then watch the basket, because it's a lot easier to be right 6 out of 10 times than it is to be right 600 out of 1,000 times. And so if we can really focus on, just a few companies, do a deep dive, and really vet out the 10 positions that we have in a portfolio, we find that we tend to outperform. And this isn't just us saying this, right? This goes back to Evans and Archer, William Sharp, the whole 9 yards. So really what we're trying to do is find just a number of really good companies in various industries and then ultimately hold on to them for the long term. Occasionally we'll have one or two positions that don't do well. We'll have about 5 that you have mediocre returns, kind of average single digits, and then we'll typically have 1 or 2 home runs. And when you do the math and when you apply game theory, we end up outperforming the S&P 500, and that's exactly what Mike's done over the 17 years with this strategy.
That's where we are. That gives you insight into us, what we're doing, and that brings us to a commercial break. So don't go away. We want to come back and talk about America's top
competitor. A recent book written by Ray Diallo, he's an investor, a hedge fund. He owns a company called Bridgewater Associates. His latest book, Principles for Dealing with the Changing World, Why Nations Succeed and Fail. He's talking about over history how the failure of England, the failure of the Dutch, and which countries took over. And he thinks right now America's in a decline and thinks the Chinese are going to be taking over. I'm about halfway through his book, but I did thumb through the rest of it to see if I was missing anything about China. But I think he's wrong, and I'm going to tell you why. And Chris and I did some research on this, and I think he's wrong because his book doesn't mention anything about the cultural differences. And I'm not talking about the culturals in the food or anything like that. I'm talking about the political differences and things that are going to restrain China from taking over and being the renminbi being the world currency like the dollar is right now. And a recent article right here from Barron's last week, if you read, is titled "Is China Decoupling is Underway?" mentioning that countries are starting to pull away from China because they've realized they've put all their manufacturing there, and the restrictions that it's causing, especially with the Ukraine war, is causing countries to start to say, hey, wait a second, do we really want to have the majority of our manufacturing done in one country? And the decoupling, and the bifurcation of the countries starting to happen. And I think this is one of the things that we're going to see accelerate, and why the China won't succeed beyond the U.S. and take over and be the dominant currency.
There's a lot of changes going on. And as you mentioned, culture is a huge difference. In America, our culture encourages entrepreneurship. In China, the focus is on developing products and innovation, but within a very specialized scope.
Yeah, and I did some research into their immigration policies, which is really interesting because they have a very strict immigration, right? They only want people to come to their countries who have PhDs and can bring something to the country. And that's a vast cultural difference, Chris and Mike, from what we used to in the United States, right? I mean, if you just read their immigration policy and then you read the simple one from the U.S., naturalization is a process which an immigrant can attain U.S. citizenship in general, and any lawful permanent resident who has maintained a period of continuous residency in the United States, right? We don't care where you come from and how you got here, in a sense, and what you bring, because we see people every day that we know that came here with nothing and made something out of themselves and were productive citizens, but that's not what they do in China. And the opposite is happening to them, because the people that have intellectual property and have something to offer to other countries are leaving the country, and they can't retain them there. One of the things that I looked at is, I don't know if you guys are familiar with this, it's called EB-5, where if a person has enough money and they want to become a U.S. citizen, they can just come over here, they can buy property and just become a U.S. citizen. And I know one of the companies here in our fine city of Seattle specializes in that, and all his money's coming from China. And so I think that, I don't think people aren't breaking the door down to get in China, where they still really want to come to the United States and make something out of ourselves. And the, command economy that China still partially has as a partial capitalistic and command economy is, I think it scares a lot of people with money, and they don't want to put all their assets in that country. And I think that's going to be part of their downfall. And as this article from Barron says, the decoupling is underway. I think we're seeing that starting to happen and it's going to keep continuing.
Well, I mean, And going into this, I was in China about 3 years ago, and I was fresh out of school. I was walking around, and I was just taking everything in because I'd never been there before. And what you find when you actually touch down and walk around is you realize everything is so regimented. Everything is done a certain way. It's one way, and there's not a whole lot of room for free thinking, creativity, right? It's more about control, right? Mike, you talk about how the U.S. is a little bit more like a rainforest, where the Chinese economy is more regiment. There's what do we use, the rows of rice, lettuce, exactly. And so it kind of reminds me of this quote. And if any of you are familiar with Simon Sinek, he's really good, but he talks about innovation and great problem solving can only happen when a team comes together with a shared vision or cause. No amount of funding or resources can replace this inspiration. And we know that China is, they get things done by funding, right? And control and, never attacking the regime. And to me, it just it reminds me of the Wright Brothers back in 1903. It really does. The two kids from Dayton, Ohio were able to be able to, the first ones to ever create flight, right? Meanwhile, you had Samuel L. Langley, who was the former secretary of the Smithsonian, a professor of mathematics. He was even a friend of Andrew Carnegie and Alexander Bell. He was a man that was really well connected. He even got a $50,000 grant from President McKinley at the time to come up with an aviation, right? But everyone is pretty familiar with the story and how it goes. Langley had, cash. He hired the best engineers. He had the best mathematicians. New York Times followed him around everywhere, but he wasn't able to fly, right? Meanwhile, these Wright brothers in Dayton, Ohio, had no funding. They owned a bicycle shop, right? They were able to be the first ones to get in flight, and no one was following them. No one was watching. And to me, this is, in a way, a fundamental difference between the U.S. and China. In the U.S., we have the freedom to just do what we need, right? We have opportunity, where in China, it reminds me a little bit of Samuel Langley. They're given everything. They have the money. They have all the top minds, but they don't have a strong why. And I think that's just a fundamental difference between the U.S. and China, and one of the reasons I don't think they'll ever replace us. They'll never replace that why.
And the other thing is, historically, how they came to power, the Communist Party. And people talk about the great atrocities that happened in the last, say, 100 years. Everybody's going to talk about Hitler and Stalin and things like that. People forget about Mao. 45 million people died with the Mao Cultural Revolution. Mm-hmm. They starved to death. It was a horrible, horrible time. And more recently, they used to have their one-child birth rate. Well, demographically, they just switched that about 5 years ago to now they can have, I think, up to 3 kids. But then people in China, because they've created wealth so fast, they don't want to have kids. They can't grow their population, and their population is aging. They have the fastest aging population in the world, next to Japan, but they have, I don't even know how many times more people than Japan, but 1.4 billion. They're going to have over 100 million or 200 million people over 65 in the next 5 years.
So what happened when they instituted the one-child policy? The average life expectancy was 64 years of age. Today, it's approaching 80s. And so when it's 64 and your retirement age is 64, 65, the number of workers you have per retiree is 40 or 50.
And their retirement age is younger, Mike. It's 50 there, 50 or 55. And we know that we see countries like the United States and Europe, as they industrialize, as people become more wealthy, that they have less kids. We know that happens. And so that's happening there at a extremely fast rate. And they have the other thing is, because of their policies, they have less women than they do men. There's I forget the difference, but it's quite significant, where they don't have enough. The population's not real equal in that sense. So they have some serious challenges demographically, and then because of their immigration policy, they're not going to just say, "Hey, let's take in a bunch of refugees and people to create another base," right? Like we would just say, "Hey, let's right? We have our symbol, the Statue of Liberty. We'll take whoever wants to come, but they're not going to do that there. So I think they've stratified in a couple of ways that are really going to hold them back from taking us over as the dominant currency. And if they do, it'll be very short-lived.
Yeah. So it's, coming out of Made in China 2025, their goal was to replace the United States as the dominant leader in technology and militarily and economically. That was what the Belt and Road Initiative is also about. But there's some really structural problems they have to deal with. And we are coming to a commercial break. And when we come back from the commercial break, we'll talk about more of these structural problems that they have in China and why we think that America is going to win the competition and why we think we are headed for the next 6 or 8 or 10 years of a market that's going to continue to do well. Right after the commercial break, we'll be coming back. If you missed this program or any parts of this program, you can find it on YouTube. You can log in About Money. You can find some of our previous programs. You can also find the podcast on our website.
In Ray Diallo's book, he talks about us right now in a process of printing money, and that's an issue for the United States. We've been printing money for a long time. Well, when you compare that to China, they've been doing the same thing. They have a tremendous debt problem, and it's crippling their country. According to George Magnus's article from Barron's last week, the Chinese economy is already facing headwinds from overhang of debt, a tipping point in the property sector, employment pressure, installed productivity, and COVID prevalence has surged. So as far as us just printing money and facing problems, China is facing, coupled with their structural problems in that countries are starting to pull away from them. They're facing worse problems than we are.
Oh, yeah. And they have priced their real estate in some of the new cities they're building at real estate prices that are equivalent to Bellevue in Washington, some of the most expensive real estate in the world. And a lot of that real estate's not even filled. They build cities thinking they're going to have 1 million or 2 million people move in. They price their apartments, their condos. But what's happening is a number of those cities are sitting vacant, and the money's not getting repaid. Evergrande filed for bankruptcy. Mm-hmm. Sadly, a lot of American investors have purchased that debt.
And just the other thing is just, another difference is that if Jeff Bezos or Elon Musk speak out against in this country and say whatever they want to say, they can say it without being disappeared. Right? When Jack Ma decided to speak out last year, we didn't see him for 6 months.
Yeah.
I mean, that's just a huge difference that is I think that's being overlooked by a lot of people that are analyzing China and the United States and saying that China's going to win.
Yeah. And I think even if you look at where they are with Made in China 2025, they want to replace the United States in terms of computers, mobile devices, cell phones, electric vehicles, agricultural equipment. They want to replace us as the leaders in those areas, medical devices, medical. And they reorganized their courts 5 or 6 years ago. And they put incentives for inventing products. In the United States, I looked up the number of patents that were issued in 2010. There were 241,000 patents issued in 2010. In China, about 30,000. In 2020, in the US, about 352,000. In China, 2.3 million. In the US, to get a patent, it's 250 or 300,000 or more. In China, the Chinese government will pay you 150,000 or more. They'll finance up to 85%. You don't find the U.S. government financing 85% of your patent.
No. Then who owns that patent, right?
Yeah. But something... Go ahead.
Go ahead.
Something happened in 2014, which really made a change in what's happened, and we're beginning to see the impact of that in 2014, it happened in the U.S. Edward Snowden downloaded to a thumb drive national secret information, national security, violated national security, and of course he's fled to Russia. But that had a tremendous impact on China because they looked at that and thought, if somebody can do that in China and download the information, that is really taking too much risk with national security. So they decided the way to do that was a top-down approach. They formed the Internet Security Emergency Command Center, the Agency Service Center, and the favorite, my favorite, the Illegal and Unhealthy Information Reporting Center. And they appointed to lead that a guy by the name of Liu Wei, who until 2016 had been the head of Beijing's propaganda department. He had 60,000 workers on his payroll and 2 million who weren't on the payroll. And he set up so that all other websites, with no exception, had to use the standard official and authoritative media reports and had to report any troublemaking lawyers that were involved or that they used. And they began to censor all the websites. They made things that were not allowed on their websites, anything that would harm national security, understood, anything that would harm China's honor, anything that would damage China's religious practices or policies, anything that would spread a rumor. Think about the people that short stocks here and the rumors they spread. No, go to prison in China for that. Anything that would disturb the public order. So you don't want demonstrations. A website that would do a demonstration. And because the Chinese language uses characters, they didn't want any intentional use of character combinations that would avoid censorship. And they wanted their companies to share data. Then 5 years ago, they formed the Cyberspace Administration of China formed the China Internet Investment Fund. That investment fund has the right to buy 1% ownership of every single internet company at a big discount, so they don't have to pay very much. 130,000 private and joint venture internet companies. China gets to appoint one board member. And board members are limited to a total of 3. So they get to appoint 1/3 of the board members. Think about that. And their main concern is not that the companies make money. Their main concern is that the companies do not do anything counter to party ideology. That's what the board member is there for. That's what the board member makes sure that they do. Make sure that it has to follow party lines. As Chris mentioned, we looked about it as rows of lettuce. Everything has to conform. In the U.S., if you compare it, it's like a rainforest, all sorts of weeds, all sorts of scraggly stuff. It doesn't matter. In China, it's those cultivated rows of lettuce.
That must be what George Magnus here in his article, he's a researcher at Oxford, is talking about, because he says China's recalibrated its industrial policy and imposes more politicized regulation and more controlling administration systems.
Well, yeah, imagine if Amazon was ordered to share all of their information on everybody who bought things from Amazon. If Microsoft was ordered to share their source of their software.
Well, remember with the FBI years ago when trying to get into the Apple phone, how long that took, right?
Yeah.
I don't even think they got in.
And if Apple had to share everybody's password.
Yeah.
I mean, that's very limiting. There was a book written by Peter Dimenis, and he had the laws about how to succeed in making a bold company. And I liked some of the things because I don't think you find them in China. He said, do it by the book, but be the author of the book. If you can't win, change the rules. I mean, think about that in China. If you can't win, you go to prison. If you can't change the rules, then just ignore them. And a no simply means starting one level higher. The squeaky wheel gets replaced. That's in America, but not in China. And in China, they have a lot of experts. But in America, an expert is someone who can tell you exactly how something cannot be done. The idea in America is to fail early, fail often, but always fail forward so that you're always learning from what didn't work. And the final rule I really like is bureaucracy is an obstacle to be conquered with persistence, confidence, and a bulldozer when necessary. Think about that. That's why we have some guy who thinks about making an automobile and thinks maybe it can compete with Mercedes, while most electric vehicles are geared toward people who are generally called tree huggers that will pay a premium just to have an electric vehicle to save the planet. He thinks there's some people out there who will pay a lot more money just to have an electric vehicle or something that may be a software program masquerading as a vehicle. Tesla. And yes, I drive a Tesla. I love the Tesla. But those kind of innovations are not happening in China. They happen in the US because there's a reward for doing that. It's the difference between our culture, as you mentioned, Al. Mm-hmm. It's a cultural difference. And it's going to continue. It's going to continue for the next
And I think
decade.
I think their talent. I mean, if I look at these charts from immigration from the Migration Policy Institute, their talent is migrating over here.
Yeah.
Their talent is saying, "Hey, we can get a return on our investment if we go over there. We don't know what's going to happen if we stay here and build something. Why should we build it?"
Yep.
So one thing that Mike had talked about a little bit earlier was if you don't like the rules, go ahead and change them, right? And so it brings me to this story that I found really interesting, and I'm also very surprised it's not talked about a lot more. But for anyone that's paying attention to the nickel market, this is going to be a very intriguing story and something that was very similar to AMC and GameStop, that we saw in early 2020. But what's really interesting is the company Censorship. It's a holding company, and it's one of the world's largest producers of stainless steel and nickel. The owner and the founder, and I'm going to butcher the name, it's Shang Guanda. Basically, people call him the Nickel King or Big Shot out there, right? And essentially, he's made a bunch of short bets that nickel would be declining this year. And he has reason to believe so, right? The price of nickel in 2019 increased by 30%, 2020, 20%, and then again, 25% in 2021, right? And so being an insider, knowing what he knows, eventually it's going to come back down, right? And so he made this bet. He made a huge bet, over $4 billion worth of trades in the shorts. And so what ended up happening in the London Metal Exchange is that people caught on to this. They caught on to these huge shorts, and then we had obviously what's going on with Ukraine right now. And Ukraine and Russia produce about 13% of the world's nickel. So what ended up happening? Well, the shorts ended up getting by the Nickel King ended up getting. A lot of people started paying attention to it, right? And so the price of nickel went from $20,000 per ton to $100,000, and all of his shorts ended up coming out to about $8 billion. And he insisted that the market would fall and that he was going to continue to short, and that's only further fueled this frenzy, a lot like we saw with GameStop and AMC. Well, what ended up happening is the London Metals Exchange actually shut down, and it ended up canceling $8 billion worth of trades. $8 billion that this man, the Nickel King, had made. Well, That's very frustrating to your average trader, right? You know, you're seeing a great opportunity to make some money. You're essentially playing by the rules. You see that there's a lot of short interest out there, and then all of a sudden one day the exchange just shuts down and it cancels all of these trades and essentially lets the nickel king walk free. And to your average investor, that's really frustrating. Because he was caught with his pants down and people called him on it. And he should really have to honor the trades that he made. But instead, the Chinese government came in and they essentially just took care of things, and it all went away. And so it's one of those things that as an investor you see, it's frustrating. It's really frustrating because not everyone's playing by the exact same rules.
And that happens not just in nickel. There have been a number of times in which large companies favor certain investors. Even if you look at the standard for money managers and for reporting, they report it on an internal rate of return, which means it always favors the largest accounts and disfavors the smallest accounts. There were trades that were done a few years ago where they were done in a dark pool, and dark pools still exist today. But the dark pool is on companies that have taken in stocks, and they will hold those stocks in their dark pool, and they'll give the best price to the biggest players who generate the most commissions. It's not really fair. And almost all the big firms have a dark pool that they will operate with. And the reason they have them goes way back to a time when you had the exchanges happening, and if somebody had a big block of stock to trade, if they had 1 million shares to trade, if they would have put that on the open market, that would have dropped the price dramatically. So what normally happens is before the trades are done, and we may talk about this in a couple of weeks, before trades are done, the afternoon before trades are done, they go out and search and find somebody that's willing to cross those trades. Find a buyer. If you're selling, they'll find a buyer. If you're buying, they'll find a seller. They go out and they do that. But in doing so, you can't do that on a normal exchange. You can't do that through the New York Stock Exchange. You have to do that off the record. It used to be called third-party trades because it was done exclusively on a separate basis rather than going through the exchange. Today it's done in dark pools. And those dark pools, you don't know if you're going to get best execution. You don't know who's getting the best trades. But the best trades tend to go to the bigger players. And today, according to the Financial Times, there's a big question now about front running, because when somebody's making a trade, they're looking for somebody to trade a big block of stock. The day before that trade goes across, the stocks, if somebody's selling, the stocks are actually dropping in price. And if they're buying, they're up in price. Morgan Stanley, the biggest block trader, is, if you look at what they're doing, the trades before they happen the next day, you're seeing the price drop in stocks that are being sold. You're seeing prices increase in the stocks that are being bought. We'll probably talk about that more.
I think Michael Lewis mentions that in his book Flash Boys. If you haven't read Flash Boys, about the high frequency trading in the dark pools, and it was who's the hedge fund guy in Pershing Capital, Bill Ackman, was complaining because he said he couldn't figure out what was going on, because every time he thought he got a price on a stock, he would hit it and it would go up higher, and he couldn't figure out. He said they were front running his trades. He said
they do. That's why I left Fidelity, because we were being traded in the dark pool. And it wasn't that much. I mean, a few pennies a share, maybe at 10 cents or 25 cents when you trade a big block. But it was just the principle of the thing. Somebody is really screwing my clients.
Mm-hmm.
I hope I can say that word on the radio.
Well, it just goes to show. I mean, imagine if you're a day trader and, a couple of cents is either going to make or break you. That doesn't. When you're playing against when you're competing against these dark pools, high frequency trading, these algorithms, these machines, the odds are not in your favor. They're really not.
Yeah. That's why we're looking long term.
Mm-hmm.
Why we actually use interactive brokers so we can see the exchange where things are happening. We're not having somebody front run us at bats. We're not seeing somebody that takes advantage of it. The point you made, Al, is right on.
Oh yeah, he makes that point in his book. If you read it, it's a fascinating book of how these guys design the whole. And the funny thing is that the high frequency traders, they were all trying to they were building these things right next to the stock market. They figured the guy, hey, if I can get an inch closer than the next guy, get my trades in quicker. I mean, there was a race to get as close as they could to the market, which was just crazy, but that's what they were doing.
Yeah. Building an optical network that went straight through, you could gain 4 nanoseconds.
Yep. And it made a difference. It made a difference if they could build that fiber optic network, have direct access and get right in it. They could get in front of those trades.
They spent $300 million to do it, and we're renting out that for $20 million a year.
Yeah.
And had so many subscribers, they couldn't fulfill every bit.
Yep.
That's why small investors can be at a disadvantage, but not at Adams Financial Concepts. So we'll be back next Saturday to talk more. Have a very good week, and thanks for Al. Thanks for Chris.
Thanks, Mike.
Yeah,
thanks, Chris.
We'll be back next week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you've heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer.